Oh, Palantir, Palantir. Welcome back to Strongman Personal Finance. We got to cover Palantir's earnings. Why? Because it's popular on YouTube, bro, and all the grifters pump the stock. So Palantir Technologies Incorporated just announced earnings, and the stonk went up 20%, which is more than VT's gone up in 100 years. So obviously, this must be a better investment than VT. So let's go ahead and read the financials, the highlights. So we got Q3 2023 earnings. GAAP net income of $72 million. So they're profitable, representing a 13% profit margin. Their margins are going up. That's good. Fourth consecutive quarter of GAAP. It's not GAAP, it's GAAP, everybody. Profitability. That means they could potentially be included in the S&P 500. And then a little vertical line, bro. GAAP income from operations of $40 million, representing a 7% margin. Now, my opinion is that this is more important in the meantime. The big difference here is because Palantir has a bunch of marketable securities, bonds, whatever, on their balance sheet. They have a bunch of cash and they put it all in bonds, basically. And they're collecting huge amounts of interest income. So that's inflating their bottom line profit. But what you want to focus on is their core operating profit, which is from their core business, excluding the interest income from the bonds on their balance sheet. But they've also improved that as well. I believe, what was the last operating margin for Palantir? Let's see. 1.89%. Okay, so that's a pretty significant swing. So they are improving their operating margin. Adjusted EPS, irrelevant. Revenue growth, 17% year over year. So they, for a while, had very slow revenue growth. Back in the day, everybody was hyping up the stock. Oh, it's growing so fast and it's amazing. It's going to 10x and 10x. And everybody was saying they were going to have 30% revenue growth year over year. It slowed down pretty significantly, and it was getting to the point where I was thinking it was going to go down to like 9%, 10%. So it is a little bit encouraging that Palantir's revenue growth has now rebounded to 17%. But you would think for like a disruptive AI futuristic, it's the future bro company, that their year over year revenue growth would increase more than that. But overall, that is a slightly encouraging sign. It ain't where the bulls said it was going to be, but it's better that they're actually transitioning to faster year-over-year revenue growth. And we're going to have to see if that continues. Most of that looks like it came from commercial revenue. So U.S. commercial grew 33%, total commercial grew 23%, government only grew 12%. They grew their customer count by 34%. So they're growing their customers faster than their revenues, it looks like. Let's see, blah, 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 blah. Cash from operations. They've never had a cash flow problem. And then they have cash equivalents, and short-term treasury securities of $3.3 billion. Yes, that is why they have way more GAAP profits than they have operating profits, okay? So let's see. Revenue grew 16%, blah, 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 blah. So let's go ahead and dive a little bit more. So for Q4 2023, we expect between $599 and $603 million. With adjusted income from operations of blah, blah, blah. So year over year, best case, they're saying that their revenue is going to grow, 603, not 503. 603 divided by 508.6. So they're projecting 18% year over year revenue, 18.5%, almost 19% year over year revenue growth. So they did get out of that. They're starting to get out of that rut of where they had declining year-over-year revenue growth consistently every quarter. Will it continue? I don't freaking know. But that is an encouraging sign. It's not like they said before, but it's encouraging. We are raising our revenue guidance to between $2.216 to $2.22 billion. So that's their full year 2023, which represents a 1906. Let's see. So they're saying 2220 divided by 1906. So they're saying year over year revenue growth is going to be 16% if you compare 2022 to 2023. Once again, that's okay. It's not 30%, but they are showing some positive signs. Okay. Alex Karp had a letter. Amazing. I'm not going to read that. So let's go ahead and just dive right into the financial statements. So their gross profit margin has, I wonder if it's increased, bro. Let's see. 558, 159. So their gross margin is 80.7%, which is, let's see if that's an improvement. Okay, so they've slightly improved their gross profit, but nothing to go crazy about. They've cut sales and marketing. R&D has actually increased a little bit, but nothing crazy. and general and admin. I suspect a lot of this is stock-based compensation going down, which is why their expenses on the accrual basis of accounting are going down. But here's the thing I want you to focus on. Remember, you want to focus on income or loss from operations instead of profit margin, specifically because they have so much stuff on their balance sheet, cash equivalents, treasuries, etc., that basically half of their profits are coming from interest income. Their operating profit's getting better, but it's not like mind-boggling, insane profit margins. I think they'll eventually get there. The real question is, how fast can they continue to grow their revenue? We know at some point, if stock-based compensation goes down or keeps going down, they're going to improve their margins over time. But it's the revenue growth story that I think is more important personally. I would completely ignore interest income. I mean, you could see the difference there. Look at that increase in interest income from 5.5 to 36. That's all because rates went up, and that will go down again. Trust me on that. At some point, we don't know when. Now, here's something funny. Look at the weighted average shares used to compute diluted earnings per share. Look at the increase in the potential shares, which, by the way, if this is all from stock options and the stock price goes up, there will be a lot of dilution. So diluted shares have increased by 12%. They are still issuing shares like mother effing crazy. It's not as fast as revenue growth, at least year over year, but a lot of your revenue growth that you're getting as a shareholder is going to stock-based compensation. That is the price of stock-based compensation. You can clearly see that is a huge increase. Now, diluted shares outstanding assumes that every share that could be exercised and converted into common stock, or every option that could be converted, every convertible bond that could be converted, anything that could be converted to common stock, it is assumed that it is converted. So the actual shares outstanding, this is the actual increase right here. This is the diluted or potential future dilution is basically what I'm saying here. So I think you should focus on this because as the stock price goes up, if people have stock options, they're going to exercise them if the stock price goes up because they can buy the stock at a cheap price and sell it at the market rate. So if you look at it, that is still some pretty incredible dilution. Do not ignore that. That's a big freaking deal. Okay. We can see stock-based compensation is going down over time. I mean, that makes sense. All right, let's see. Balance sheet. Obviously, their balance sheet isn't a problem at all. You can clearly see that a huge portion of their cash is in marketable securities. That's where their interest income is coming from. Okay. Let's see. They didn't really buy any property, plant, and equipment. They didn't really sign any new leases. Yeah, nothing really crazy on here. Nothing that scares the crap out of me. Now, cash flows from operations, it looks like they had a pretty significant increase in cash flows from operations. That's actually a pretty incredible increase from 144 to 411. Let's see, where is that mostly from? I guess deferred revenue, customer deposits. A lot of that was basically upfront payments from customers is where a lot of their cash flows from operations came from. Let's see. Purchases of marketable securities. Yeah, I mean, there's really nothing wrong with their cash flow statement. You can see, though, proceeds from the exercise of common stock options. As the stock price goes up, people are going to be exercising their options, which leads to more dilution. And the dilution ain't nothing to laugh about, okay? So overall, this is better earnings than the last one. The last one, everybody was, creaming themselves. I didn't get it. I was like, okay, they had a 1 or 2% operating margin. Wow, that's so amazing, okay? But they are improving their margins. Their revenue year over year is getting better. So there's some encouraging signs. Now the question is it a good value? I don't see it. Okay, I mean, if you look at the, just valuation metrics, price to sales, 18. Price to books, 13. Price to free cash flow, price to operating cash flow. This thing is still very richly valued, okay? Just because a company had, decent earnings, which I'll say they were decent earnings, I'm not going to say that, oh, you can just buy it, because it's still very richly valued. This stock went absolutely bananas once the whole AI clown market started, okay? And a lot of the clowns that still bought it, they bought it all up here, but now they're pretending they bought it down here, which is pretty funny, okay? But overall, I mean, not the worst earnings in the world. I think they will continue to improve operating margins. That wouldn't surprise me at all. But I think a lot of your future earnings are going to be eaten up by stock-based compensation, which has been very significant. It is still very significant. Okay, I don't know. They need to stop doing freaking doing that. That's the one thing I don't like about this company. But great job, Palantir investors. You guys are so amazing. Instead of buying a total market index, you decided to buy Palantir at $40, $30, and now you're only down like what, 30%? So that's my overview. Not bad, not the worst in the world. There are some encouraging signs. But the question is, will it continue? Because if it doesn't, the stock can still get shellacked. All right? Talk to you later. Cheers.